Very good evening to everybody. It is Monday. It's an unexpected live. I was going to wait until Thursday and do a sweep up of the Nationwide HPI and the Halifax HPI, which is due out on Thursday. But the figures that came out on Friday when Nationwide released their latest house price index has caused a little bit of a stir in the industry. So what I wanted to do was go live today, look at that data, actually crunch the numbers, see what's going on and relate it to the wider economy. Last week, if you're on last week's live stream, we talked about what's going on with the economy. I'm going to recap that as well, so we can tie them together and hopefully make some predictions about what's going to be happening over the next 6 to 12 months in terms of trend. Firstly, before we do that, if you can see and hear me on the live stream, please give me a thumbs up. Please put something in the comments box. Good evening, Sean. Look, I want this to be as interactive as possible, so please make sure you put comments. I'll answer all of your questions if I can. If you're new to the channel, please do yourself a favor and subscribe. The point of this channel is to cut through all the headlines, look at the actual objective and empirical data for us to make better investing decisions as property investors. Sorry, hitting the mic there. I just want to say a big thank you to everybody because we hit 2,000 subscribers over the weekend. So I won't worry you with figures until we get to 5,000. But we're growing the channel. We're growing the channel quickly. And the reason I ask for people to subscribe is it does effectively give me more ability to reach more people. Therefore, we can put more resources into this channel to get more information out to you. So I hope everybody is fantastic this evening. Right, let's crack on with no further ado, because you've probably seen the headline data, right, with the Nationwide HPI. So I'm just going to go through that, but then look under the hood into that data set. I'm not sure if this took people by surprise or not, but my gut feeling is the media jumped on it. A lot of people are like, whoa, we weren't expecting that much of a correction over this month. So I want to see what's caused that. First of all, in case you have not seen the news, month on August, Nationwide posted a 0.8% drop, which is the biggest drop we've seen for a long time. Now, I know there's been a lot of commentators, especially on YouTube, saying, where's the housing price drop? Where's the crash? It's been there, right? We've been going through it slowly and steadily, and this is another slow, steady drop. When we look at the overall picture in a bit, we'll see where we are. I'm also going to relate it to real house prices because that's quite important. But the biggest thing that came out of this, right, is the annual change of minus 5.3%. So that's now the largest annual, so comparing now to 12 months ago, drop we've probably seen since I think it's 2009. So a fairly significant annual drop we're now seeing. Something to put into context here is we are in the slow month. So this is the August house price index. I know a lot of the bulls are saying, look, it's summer, everybody's away. The reality is, yes, we do see a slowdown over summer, especially August. And even though this is August data, a lot of these transactions are probably deals that were done in July, potentially even June, because a lot of time people are going out, they're agreeing deals or property purchases, and then they're going out and applying for mortgages. So these are directly related to mortgage approvals that happened in August, which means the properties could have been sold in July or deals agreed in July or June. So that's the first thing to say about that. So I'm actually surprised to see it down this much. It's more than I was expecting. The report's come out with a lot of graphs that I've not seen before. And I want to talk through these graphs. It's giving us a little bit of context behind what's going on as an overall picture. And if we look at this, if we look at house purchase transactions by buyer type, we can see that right now in the market, cash is king. Okay, no surprise. Interest rates are going up. Bank of England base rates going up. We have seen over the last month or so a slight reduction in lending rates, and that's because the difference between the swap rate, which is the forward projecting hedge effectively that banks borrow or lock in their borrowing at before they lend it to us as a consumer, and Bank of England base rate. So because confidence has come back into the market, over the last month or so, we've seen headline mortgage rates drop down probably about 0.5%, maybe even more than 0.5%. This actual graphic here goes to June 23. So this is a lagging data set. Now, if we go into this, we can see cash is the top. I'm actually quite surprised. I've never seen this graph before. If anybody else has seen this graph before, I'd love to hear your thoughts on it because I've never seen before. And I was surprised that cash buyers, right, actually outnumber the first-time buyers with mortgage or movers with mortgage. I know when you combine them, they're going to be more. But I was quite surprised by how many cash buyers there are out in the market, right? That's obviously showing there's still good liquidity out there. Now, when you look at this graph, you can see we've got an uptick in people taking mortgages because we've seen a huge drop off, right? If we go here, we see this sort of ski slope effect. This ski slope effect, if you look at the dates, is triggered by mini budget. Okay, so it's triggered by the September-October mini budget that caused that massive spike in swap rates. Okay, we saw mortgage rates go over 6%, and everybody panicked, and we saw quite a large drop in house prices, if you remember, back in that time. And then as we came into the beginning of this year, some confidence returned to the market, and we saw the mortgage rates come down because the swap rates came down. Then in June or July, I lose track a little bit, we saw the inflation data came out, which was concerning. So it was not a lot of drop. And then we had a month on month where it didn't change. And the markets went bananas again, right? And the swap rates went back up to over, whatever it was. And the mortgage rates went over 6% again. And the reason I'm saying this to you is what is going on here always lags. The housing market is going to lag what's happening in real terms. And also the actual market, how they price things, is very short term and very reactive. So we can actually hypothesize what's going to go on in the future in the next 3 to 6 months with some accuracy, right? So if we follow this graph through, I fully expect this graph to actually start dipping off again. So we've got this ski slope with the mortgages, okay? Ski slope going up. If I can just go, in fact, give me a sec, team. Let me just get my draw tool, if I can get the draw tool out here. I'd expect this to come up and drop down again, both of these. When those effects of that swap rate pump a couple of months ago take effect into this. Right now, we are probably getting some market sentiment returning, some positive sentiment returning. So we're probably going to see it go up a little bit. So this is when this all feeds in, when this lag feeds into the system, okay? A lot of what happens to the housing market is based on perception. So when we see positive sentiment, right, we're going to see a little bit of recovery. When we see negative sentiment, it's going to drop again. And we're probably in August, those figures are probably now seeing some of that drop from the negative sentiment we had when those inflation rates came out a few months ago and the swap rates went up and the mortgage rates went up. That's now feeding in. Therefore, if we look over the next 3 to 6 months, I'd expect that probably start shallowing out because the sentiment is very much returning right now. Sorry if I'm not quite looking at the right part of the screen, by the way. I've got some new apparatus. I'm completely reshooting and redoing my Property Cashflow Accelerator program. I've got an auto cue and it's a bit weird. I'm looking at things a bit differently. Anyway, so I thought that was quite fascinating to see. As an investor, again, what is super obvious here is this trend down in the buy-to-let market. So we talk, I need to go on here. In the buy-to-let market, we talk quite a lot, or I talk quite a lot about, is buy-to-let dead? You see other commentators talk about, is buy-to-let dead? For me, when I say is buy-to-let dead, I mean, is traditional, buy a property, half decent area, put a 25% deposit down, 75% mortgage, just sit there and get an income coming from it. For me, that is the market that is dead. And you can see this evidence with the amount of, that downtrend we've got in the buy-to-let market world. Landlords are leaving. There is an exodus that is causing a rental issue, which we won't talk about today, but we'll talk about it another time. Right, that part of buy-to-let is dead. Of course, there are many models that are working super well at the moment, but standard buy-to-let is really struggling in the current interest rate environment. So that's an interesting graphic. Now, let's have a look at the house purchase transactions by buyer type to see the demand. Now, last week I spoke about the Zoopla HPI and it gave us an overall drop in sort of demand, which I think was something like, it was 20 sales or 20% down. I think demand was somewhere between 30 and 35% down overall. We can see here, right, we've had a huge drop in demand with home movers, with a mortgage, slightly less buy-to-let. I say slightly less in terms of the drop, right? Home move with mortgage still over 30% drop in demand. Buy-to-let purchase almost 30%. Still more first-time buyers. The first-time buyers still more active. Remember, we talked about that migration from south to north, but also where if you go sort of above that line that splits the Midlands, further north than that, it's actually more expensive to rent than it is to buy, even with the higher interest rates. So we're seeing a lot of first-time buyers in those areas still having a strong demand or looking for property because it's cheaper to buy than it is to rent with the rental crisis we're having. However, right, we're still minus 24% here in terms of demand. So even though first-time buyers are being more resilient, they're still way down on average. Here we go. Cash, people are buying. There's demand. People with cash are stepping in. And I'm not sure if that shows that people with cash are positive. They don't care about they don't care about short-term house price fluctuations, because long-term they always think it's going to go up, or if there's some spectacularly good deals with cash. Again, I look at that as an investor, and I've been saying for a while now that investors with cash, there are some fantastic deals on the market for investors with cash when you disconnect it from that artificially high sort of interest rates that we're paying right now on bridging or development finance. Right, let's look at the next graph. This again is showing where the opportunity lies, or showing where the major shifts are happening. We talked about more expensive houses, demand dropping from there. The biggest drop in demand is for detached houses by a significant amount. For home movers with a mortgage, almost 40% down. That's 37% down demand on buying detached. Better with flats. So effectively, again, we've got that curve. So the smaller the property, the less the demand. So again, this just backs up our narrative of effectively almost like a net migration within our country, both geographically and size of houses. People are downsizing. I'll do a walk around in my area soon and show you how many more to let boards are up. For sale boards are up. Now, I also want to talk about some of the rhetoric that goes into these reports, because page one, after they're saying we're the biggest year-on-year drop since, I think, 2009, bigger than anticipated month-on-month drop, we still get the rhetoric of, nevertheless, a relatively soft landing is still achievable, providing broader economic conditions evolve in line with our and most other forecasters' expectations. I just wonder how long it will take until we stop using the word soft landing. How many percentage down year on year does it have to be until those with an agenda, be it Zoopla, be it Rightmove, be it Nationwide, be it Halifax, the banks are businesses, right? The banks need us to do business. And what is very obvious right now is that we are in a crunch, in that the whole market is freezing up. Demand is falling off a cliff. Sales transactions are falling off a cliff. Therefore, the banks cannot lend money, okay? Because if nobody's buying or selling houses, they're not going to be putting out new mortgages. So it's in their interest for people to be out there buying. So you look at the rhetoric that comes out on these indices. Again, Rightmove, very much motivated to get people using Rightmove because that's how it makes its money. Same with Zoopla. They don't want everybody to run away and stop buying. They want people to come in and buy properties. Now, is this a disingenuous? Is this putting narratives out that are influencing people? Let's just compare what they've said here to what's going on in the economy. Because, by the way, even though it's rhetoric, it's not completely necessarily wrong unless you look at it in terms of real-term house prices, which we'll relate to in a little bit, and go, actually, we are having a major crash at the moment. And I believe we are actually in a major real-time house price, although nobody is talking about it. They do leave in that comment, if I just get rid of that green thing, they say, in particular, unemployment is expected to remain low, below 5%, while we are upticking, and the vast majority of existing borrowers should be able to weather the impact of higher borrowing costs given the high proportion on fixed rates, and where affordability testing should ensure that those needing to refinance can afford the higher payments. There are loads of massive sweeping generalizations in that sentence, okay? So basically they're saying the soft landing is achievable as long as unemployment doesn't go up and people can afford their mortgages, right? And I'm not saying that unemployment is going to go up. I'm not saying that people cannot afford their mortgages, but that's quite an obvious statement to go, look, we're going to get a soft landing as long as people don't get sacked and can afford stuff, right? However, when we look into it, will unemployment go above 5%? I don't know. We will probably never know because the stats are so skewed. I think the biggest thing here is when it says the high proportion on fixed rates. Now, I have been saying for a while that I feel there's a race going on at the moment, and that race is between people's liquidity running out. There is clearly a lot of liquidity sitting about, savings, borrowings on super cheap rates out there from that post-COVID bonanza of money printing and liquidity getting put into the market. There is a race between that running out, and it is, again, not this week, probably next week, I'll look at the net savings outflow, which is very obvious that we've got billions of pounds coming out of people's savings accounts at the moment. Race between people running out of liquidity and the length of time interest rates stay high. Now, nobody's expecting interest rates to stay above 5% forever. Okay, everybody's expecting interest rates will peak, whether it's 5.75, 6, 6.25, and then come down. And then depending on where they settle is what's going to direct the future of the housing market, I would say, for the next cycle. right? If we settle between 3 and 4%, I think we'll be stagnant in the market for a long time. If whatever happens, if something happens and we go back to pre-pandemic levels, sub 1%, then clearly we're off to the races again with property prices. However, the length of time that these interest rates stay high for, and when I say high, I do mean above 5%, the longer they're there, the more people are coming off fixed rate mortgages. There's still, for the next 12 months, 110, 120,000 people every single month coming off a fixed rate deal of cheap debt onto, whatever the new one is. That gap, that equation is getting bigger. So more people, liquidity is getting chewed up, more people are chewing through their savings, and we're still in a cost of living crisis with high inflation. Even though it's come down, it's still 4 times target, right? So if that inflation stays high, and we'll talk about this in a bit when I look at predictions, if this inflation stays sticky, whatever that sticky actually means, right, those interest rates are going to stay higher for longer. And I suspect we will be in a situation where interest rates will stay higher for longer, and therefore we'll see how that goes with people's liquidity. I'll be interested to hear your thoughts on that, team, in terms of where you think interest rates are going. Put in the comments right now where you think interest rates are going over the next 1 to 3 years. Where do you think we'll be in 3 years' time? When do you think we'll get below 5% again? I'll be interested to hear your thoughts on that. Okay, so anyway, Nationwide are very much relating the soft landing, whatever a soft landing means. I don't know what the qualification or the quantification, when you're looking at data, people say soft landing. What does that mean? So we're already 5 points, whatever it is, percent down year on year. What is a soft landing? They're relating to the economy. Let's just give a quick recap of how the housing market and the economy are symbiotically linked, okay? Whether we start with a fall in house prices or fall in GDP, right? Let's say house prices are coming down, which they are now. People, perception-wise, is we have fall in wealth. Well, perception, we do have a fall in wealth, right? Fall in wealth, confidence goes down, we lower the spending, GDP goes down, that impacts house prices. We could see, the economy is so propped up by the housing market. If the housing market grinds to a halt, a lot of the economy starts grinding to a halt. Because when you think about it, right, how many jobs are in the construction world? A lot. When people move, what do? They use professional services. They generally buy new furniture. They buy new kitchen equipment, right? They throw a load of things out and buy a load of new stuff. People moving houses is one of the wheels that makes our economy go round and round, right? And if this all crunches up and people stop moving, it's going to stop actually quite a lot macroeconomically, a lot of spending going on, and that is going to impact on economy. Economy shrinks, unemployment goes up, right? And we get into this vicious circle. So this is why we don't want to see this spiral, because it could get nasty if we do, right? It is a possibility. I'm not saying it's the highest possibility, but it's a probability on the spectrum that could happen. Where are we with the economy at the moment? I went through this last week. Let's just do a quick recap. Okay, this is effectively, are we expanding? Are we contracting? The purple line here is the composite. The red line is manufacturing, and the green line is services. We're now dipped on the composite below the expansion line over the last few months. So confidence is definitely down. Businesses are feeling the strain. We can see here that retail sales volumes are certainly not going up. Consumer confidence is dipping down again. We're at minus 30%. Last reading, monthly change in retail sales volume, minus 1.2%. I know a lot of that was put down to the wet and windy July. We'll see how August fares, but it wasn't particularly great either, even though it's swelteringly hot right now in my little underground bunker. So all these indicators are not looking brilliant for the economy, not in sort of full-on crash mode, but not looking brilliant. And if we look at that inflation, that core inflation, that red line, right, is still staying high. So if we cannot get that down, okay, those interest rates are going to have to stay high for longer. The longer those interest rates stay higher for, sorry, I've just realized I've not been showing you that. Let me just go through those graphs again. I do apologize. So we saw this, right, which are the lines coming down from this UK businesses feeling the strain. We've got retail sales volumes. We've got consumer confidence is the purple line. Okay, and then we've got the inflation figure. And if that core inflation, if this red line does not come down substantially and quickly, those interest rates will likely stay higher for longer. The way this works is there's such a lag. The longer they stay, we're really feeling the effect of them in 12 to 18 months' time in the economy. So what we're seeing in the economy right now, let's rewind 12 to 18 months. Let's just go 12 months, right? Rewind 12 months, and we're the end of summer 2022. I don't know where we were in terms of interest rates, but we are probably, we were a third of the way up from where we are now. And that is what's being felt now. So let's fast forward 12 months and interest rates are still going up. 12, 18, 24 months, this could be getting a worsening picture, right? So what my general feeling with how markets talk and react is they're very, very short term in terms of their out projection. They see a data set, right? And they'll see 1 month or 2 months and they go, boom, that's where we are now. So for example, all of the indices talk about the housing market being cushioned by mortgage rates having peaked and coming down now, which is a very, very short-sighted view because they put out that narrative, right? When they put out the narrative, mortgage rates have peaked, they're coming down, they're starting to, sort of descend. People go, oh, it's over, things are going to get better from here, we'll go out and buy stuff, completely failing to understand that those mortgage rates could easily spike back up. All we need is some very minor third-party input, right? Or we need a couple of months of inflation staying level or core inflation going level, right? And the interest rate's going to go up again, and those swap rates are going to go up again, and the mortgage rates will go up again. So we need to start looking 6, 12, 18 months in the future, not just 1, 2 months in the future, okay? That's where we need to be looking. So what else are we talking about? Yes, that's the state of the economy. Now, let's look at the actual graphs behind the Nationwide index, right? And this is the annual percentage change in UK housing prices. And the reason that I titled this, Have We Finally Capitulated, right? Or has the crash actually now happened? Is when I look at that, we had this initial, and again, sorry, I just need to draw. We had this initial drop. This is year on year, right? This is not house prices. This is the year on year drop. And then we had that sort of cushioning where it sort of leveled off a bit. And now we appear to have broken that pattern. I don't know if we can do traditional charting for property because it's so slow and laggy. But we've now broken that sort of slowdown and started to dip down at a higher rate. So that sort of looks like a capitulation style curve rather than a recovery style curve, right? So the question is again, how far down is this going to go? We're about to hit 6%. I know some people, some of my colleagues or fellow YouTubers were estimating we'll be 5% down by the end of this year. Well, according to Nationwide, we're almost 6% down already. But what's going to happen over the next few months, right? Something we need to understand when we look at year-on-year prices is what happened a year ago, okay? So we could, for example, see a drop in property prices month on month, but actually the year-on-year goes up depending on what happened in that same month a year ago. Now, I would say now we're starting to get to a stage, or we're probably at a stage now where we're getting to a realistic year-on-year drop in property prices. You can see down here, August 23, right, we're at minus 0.8. If we zoom out and go August 22, right, we're at plus 0.08. So effectively, what's happened in this data set is that plus 0.08 from August last year has dropped out and it's been replaced with a minus 0.08 from this year, which is why we've actually got quite a large monthly drop from minus 3.8% to minus 5.3% in terms of our annual year-on-year drop, okay? So we can start to look at what's going on with these figures from September 22, October 22, November 22, etc., and get an idea of where we're going to be going with this. So we can see, sorry, let me just get those circles off. September 22, right, we had minus 0.1 of a drop, which means if September 23, we have anything more than minus 0.1, right, this figure here is going to get a bigger negative figure. However, we saw quite a substantial drop between October and November 22, right, 2.3% drop between those 2 months. So unless we're in proper free fall, the chances are that annual drop in house price is going to level off. It might even probably even raise. Let's say in October and November this year we drop 0.3% and 0.4%, right? That year on year will actually start to recover. And people go, oh, we bottomed, but we haven't bottomed, right? We're just looking at that year on year. So we have to understand that data and where it's going, because when we come sort of over here, right, we've actually got net, not a huge amount going on here. So that means this time next year, right, if we're still dropping into Q2 of 2024, we're going to see some quite substantial drops again year on year when these things fall off the radar. Hope that makes sense. So I think that's important to understand where we were this time last year and what was going on. Finally, let's look at the actual average UK house price that Halifax talks about. If we zoom in, we can see we've had our quite steep drop. Oh, dear me. Oh, I pressed the wrong button. Give me a sec. Let's go back into that. right, you can see that we've had our fairly steep drop, then we've had a little recovery bounce, and we're now definitely on the way down. Now, we are still, if we draw a line like this, right, we're still not as far down in annual house price as we were when we hit the bottom of that initial drop several months ago. But if we do break that line, it would be interesting to see what happens when we do break that line. If we do break that line, the question is, how far down do we go? And don't forget, these figures are slightly misrepresentative because they are nominal house prices. We'll have a look at the real house prices in a bit. But what is important to note is this sort of, drop and then a little bounce is not unusual. If we look at 2008, this is the 2008 crash. We can see we had the drop, we had the bounce, and then we had the final capitulation. This is fairly normal market cycle in terms of confidence. You'll always have, not always, but very often have that little sort of dead cat bounce, even something as slow moving as the property market. Okay, so I think, why do I keep pressing the wrong button there? Here we go. Sorry about this, team. It's because I haven't got a pen with me. I'm using my fat finger. Now, this, by the way, this graph here is the graph that I look at and go, actually, we are not going to crash. So I'm going to talk about three possibilities in a moment. Possibility one is a full-on, I'm just going to come off that. Possibility one is a full-on market meltdown, property crash, right? Like carnage, blood on the streets, 20-30% drop in nominal house price over the next couple of years. That's scenario one. Scenario two is the longer, shallower correction in house prices. That's more healthy, that's more stable, and actually has a greater correction in real house prices than nominal house prices. Since I started this channel in end of February, that's the one that I've said I think is the most likely given the scenario we're in, given the macroeconomic factors. Scenario three is actually we are bottoming out, right? We are getting there and we're going to start a revival or recovery sometime soon. I'm going to look at the reasons or the factors that would influence that to create one of those three. But this is the reason that still now, right, I look at this and I go, we're not going to massively crash like 20-30% in the next couple of years. By the way, I could be wrong, could be completely wrong. Something might happen, it might be carnage, but this is the UK house price to earnings ratio, okay? And I've done it again, sorry guys. I will go on some remedial iPad drawing with my finger rather than a stylus. Let's look at this. This has come down substantially, and if we draw a straight line, we're at round and about 6 times house price to earnings ratios. Now, some people might go, well, that seems quite low compared to where we are. This is the nationwides. Halifaxes will be different. ONSs will be different. They've all got different models. And the nationwide tends to forecast, it does forecast a lower average house price than the Halifax and the ONS, which is why when I looked at this, I was like, okay, we're topping out here at about 7 times. And I know I think we've actually hit 8.2 if you go on the ONS figures. My point is we've had a substantial correction already in the UK house price to earnings ratio, which means, by the way, means that houses are becoming more affordable. Now, looking at this, we're now more affordable, right, than we were at the first little peak here. Definitely more affordable than the crash of 2008, which is a completely different set of circumstances. And we're actually below this affordability bracket or thereabouts that we ran from sort of 2014 to 2018 in terms of nominal house prices, okay? So when you look at this, all of a sudden you go, wow, things have corrected quite a lot. And house prices don't suddenly seem super expensive. The reason for this, by the way, is because we've had such high wage growth and house prices are now coming down. So we've had a combination, we've had a narrowing, of, coming together of wage growth going up, house prices coming down has created that affordability improvement. A few weeks ago, I ran through this model that was on a Resolution Foundation white paper on the future of interest rates and how that's going to affect the housing market. And they predicted that if 10-year gilt yields, right, ended up at around the 3%, sort of settled around the 3% mark and stayed there persistently, okay, we would end up here, which is UK affordability ratio of 5.9, okay? So when we look at this, we're still at, I think it's actually 6.2 on this graph, but we're coming down to that fairly quickly. And this was the new norm. Now, it did also say, right, that if interest rates suddenly drop and real-term interest rates are, back to negative and real interest rates are, sub 1%, we could well go back up to 10 to 11 times UK house price to earnings ratio. which would be a massive explosion in asset prices. But this right now in that Resolution think tank report was the most likely scenario of readjusting down here. Bearing in mind, this line is actually quite outdated now. It's kind of the end of 2021. So we've still got it going up here, but really we're now down around here, I would say. So when we look at that, that's come down a lot. Okay, it means house prices become much more affordable. Now you're probably going, why has that come down so much? Because that's a fairly dramatic drop. And the answer to the question, right, is what I talk about every single time I go live, is that everybody else seems to be ignoring the fact that we should be looking at real house prices, not nominal house prices, when we're looking at these economic factors, because real house prices are the actual value compared to everything else in the world. And in a high inflationary environment, which we are in, everything else is going up, wages are going up, goods are going up, services are going up, house prices are coming down, which means in real times, houses are devaluing quite substantially. End of Q2 this year, we are 14% down year on year. I worked it out, right? 14% down. We're not far away from the end of, well, we've got one more month, don't we, for Q3, and then we'll see where we are at the end of Q3. House prices are looking fairly cheap in terms of real house prices. We're probably, almost down here now. I would imagine. I'd be very interested to see. We're probably almost bottoming out where we did at the bottom of the 2008 financial crisis, which, by the way, if you look at peak here to trough is 2013. That's 6 years for real house prices. If we look at the 90s, right, exactly the same. The nominal house price in the crash in the 90s took 2 years. The real house price crash went from end of 89 to, I think from memory, beginning of 96, 7 years. 7 years in terms of real house price decline. I feel this is the most likely scenario for where we are now. And because that's the most likely scenario, I suspect we'll see a long, drawn out reduction in real house prices, which will be a much shallower reduction in nominal house prices because we're in a higher inflation environment. Of course, it depends. Inflation might undershoot or overshoot the target, and by next year we'd be at minus 2% and be in deflationary environment. I don't know. I'm just looking at the trends of where we are right now. What I'm going to do, team, because I've been rabbiting on quite a lot, is I'm just going to take any questions before I look at those scenarios and what's going to cause those 3 scenarios I talked about. So give me a sec whilst I look at some questions. Health is wealth. Currently looking for a house in North Devon and finding sellers are still in the denial stage. I think something that I'm seeing on the shop floor is people are still having a go listing wise. They're still listing high. And I think that is very much driven by agents going high. But they're not selling. And the longer they stay on the market, right, the more motivated these people are, I can assure you. In terms of demographics that are way, way ahead of this in terms of expectation on landlords. So when I talk to my clients, I say one of the best demographics we should be buying from right now are baby boomer landlords who are retiring, right? And they just want to offload because they've got huge amounts of equity increase over the last however many, years, decades they've been holding stuff. And they just want to get rid now. And there's a huge demographic that wants to get rid. So they're the best. They're the most realistic expectation. The rest, I predict, will follow. Yeah, Andy says as long as no recession. Sean, you pretty much nailed it. Oh, thank you. I much appreciate that. How much of the decline in house prices we see is largely determined by where interest rates settle? 100%. I think it's going to settle at 3-4% due to sticky inflation. Sean, I 100% agree with you. That's exactly the range I predict it will settle based on the current trend lines. We'll talk about that in a second. Stuart, interest rates peaking at 5.75%, rates staying above 5% until the middle of 2025. Yeah, good. Yeah, I reckon it'll be 5% all of next year. I also agree with that, but we never know. Markets are pricing in a base rate of no lower than 4.75 medium to long term. Amy, that would be high, right? 4.75 persistently is above what we are sort of predicting in those reports. Interesting, it does depend on where inflation ends up. If we're hit inflation target of 2% and we're at 4.75 base rate, that's effectively a real term interest rate of 2.75, which is way higher than anything we've seen in huge, in decades, right? Decades and decades. So that'll be interesting to see where inflation, because inflation stays higher, those interest rates will obviously stay higher. That real interest rate is one of the key drivers for me. Chaz, don't worry about being late. We will. You can catch up for it if you want. Right, guys. Lots of. Anyone listen to Mike Weathering? Yeah, crashes in the liquid. Assets are always slow burners. Great. Team, what I want to do, rather than go through, there's got a lot of questions today, which is awesome. I'll do some more of those at the end. I'm going to move on to my predictions of where we're heading, okay? So if I can move this, oh dear, there we go. So we have 3 main scenarios here. We go into full meltdown and crash, we go low and slow, or we go into recovery. What is going to create each of those 3 scenarios? Crash. And by the way, so I always think if anybody sits there on YouTube and goes, house prices will drop exactly 6.3%, they're just guessing. And they're hoping they're going to be right. And what you probably see is they probably do lots of different videos and they put different figures on. And then when they hit the one that's right, in a year's, 2 years' time, they'll get their video and go, look, I was right. I don't think that's the fair and accurate way of being a sort of pundit or a commentator or crunching the data. I know a lot of stock traders, share traders do the same. They kind of hedge what goes out and then they pick the one that is eventually proven to be right. I don't want to do that. I want to say there is a quantum of probabilities, right? There are some that are more likely. So in the middle, we're going to have probabilities that are more likely. At the outliers, they're going to be less likely. We need to understand all of those and what's causing all of those. So on that quantum is the reality of a massive nominal house price crash. 3 things for me that's going to cause that. 1 is interest rates go up or continue to go up from where they are now. And I mean Bank of England base rate, because if the Bank of England base rate keeps going up, swap rates will have to follow at some point. We can't be up at 6-7% and banks are lending out mortgages at 4%, right? So interest rates continue up. Why would interest rates continue up? We can't get inflation under control. That is kind of simple as that, right? That inflation will not come down, but not come down. It probably starts going up again. We're going to have to whack interest rates up. So if that pass the parcel inflation or that strong wage growth, this must be a head scratcher for the Bank of England right now. If we can't get it under control, interest rate will have to continue up. Unemployment up. It kind of goes in lockstep that if the interest rates continue up, it's eventually going to stop businesses. People will stop spending money because that affordability continues to get worse and worse and worse and worse. Stop spending money, businesses contract, unemployment goes up, and effectively we go into recession, right? But a deep recession. That's probably the scenario that's going to lead to a massive property crash. But it's such a slow burn. I can't see it happening right now. As we go into 2024, this is why we need to keep an eye on all the trends. We need to keep an eye on unemployment. We need to keep an eye on inflation. We need to keep an eye on everything to see where those trends are going. If unemployment starts, going up quite rapidly, that's going to be a real concern, right? That is probably the thing that's going to end up. Because right now, the property market is not crashing because people can afford their mortgages, because there's still a huge amount of people on cheap fixed rate debt, and the wage growth has gone up, which has made it more affordable for people, and there's still a lot of liquidity in the system. This could change, but I don't see it happening quickly, okay? What I do think, I talked about this earlier, about how the markets react very short term. Don't need to go about that. This is the Bank of England's fan chart, by the way, for unemployment over the next 2. This was at the beginning of 2023. I need to find an updated one. I think they do this annually, but they had a fan chart that ranged from 2% to 7%. So a lot of commentators say they don't think it's going to go above 5%. If you look at that middle deep purple, it's in the bracket 4 to 5% by the time we get to 2026. Actually, let's see where we are now. We can see it trending up. So we're at 4. Yeah, we're kind of sitting right now at the top of that deep purple at 4.2% was the last read on unemployment. I think if we pop above sort of 4.5% by the end of this year, that's going to be a concern. And again, we just need to watch those trends. If we start popping into this area, and particularly that area, right, that's a real issue. If we don't get above there, fine, right? As long as we stay in that purple, fine. But let's just see where that goes. We'll keep looking at this every quarter, every year. That's important. Okay, I don't predict a massive crash happening this year. We'll see what happens next year. Low and slow. Interest rates, I've got here, interest rates settle higher than 3%. By the way, this is my personal opinion. This is with no economic analyst background. I'm a pilot that buys airplanes, right? Ex-pilot that buys houses. I have no formal training in this. My feeling is if interest rates settle long-term higher than 3% with inflation back at target, then we're going to, no, not inflation back in target, with sticky inflation, i.e., where are we now? The target is 2%. We're at, was it 6 point something? But that core is up at 6. If we I have a feeling, I just have a gut feeling, we will get quite quickly to Sunak's pledge of half of what it was, which I believe is 5.1% by the end of this year, right? I feel we'll get it because he has to make that work. He has to make that stick, so to speak. And then I think it's just going to flatline. Because when he's met it, right, all that real sort of stickiness, core inflation that's not going down will be there. That's my gut feeling. I don't know what you guys think. I'll be interested to hear what your thoughts are, but my gut feeling is that's what will happen. So sticky inflation, we keep on in a strong labour market, and I think, reality is I would say we're in stagflation right now. Now, one of the hallmarks of stagflation is rising unemployment. And we are seeing that slight uptick, but there are some dichotomies in what's going on at the moment. We still have a strong labour market right now. That is undeniable. It might be softening. In fact, it is softening, but it's still strong. How much does it soften and how quickly and how resilient are those businesses going to be? The leading indicators are showing not the most brilliant signs in the world, but we're not there yet. So we need to carry on watching those leading indicators. And people's affordability increases, right? If we have sticky inflation, affordability increases by people's nominal wages carry on going on. That is creating a cushion. I believe this is the most likely scenario. And as I've said, the big reason for this is that in real terms, we are actually having a house price crash. But we're talking, when I say low and slow, I mean nominal terms. So nominal terms, low and slow. Real terms, we are crashing. That's just undeniable. Nobody else needs to be talking about it. Interestingly, by the way, something I am doing is keeping an eye on some of the leading indicators, some of the real granular leading indicators for the economy. So I'm keeping my eye on is wholesale gas prices, because I feel that if we get into another gas or energy crisis, that's really going to put a strain on households. So right now we're looking pretty good. This was taken today. I took this today. This is the spot price graph. We're sort of, we're sitting around that sort of 85 pounds. Is it pounds or p? I never know. I think it's pounds a therm. We did dip down into sort of the late 50s, I think was the lowest sort of here, and here late 50s or early 60s. But we're still settled around historic sort of gas prices, none of this ridiculousness. However, if that changes, boom, that's going to hurt everybody, and it's also going to go into the supply chain, affect inflation. The other thing I'm looking at is Brent crude. This is definitely going up. I don't know if you remember when 2 months ago the CPI print came out, and it dropped quite. It's the first one where it dropped more than people expected, and almost exclusively the reason for that drop was described, or the reason or the narrative behind it was that the cost of transport had dropped considerably due to the cost of fuel. Okay, so basically transport fuel had dropped out of the data set. And it was this sort of area, just like with the energy, right? When the energy prices dropped out, we saw a big drop in the inflation. When the transport fuel prices dropped out of the 12 months rolling, we saw a big drop. And 2 months ago, when we saw that big drop, it was because of this. However, I said at the time, bizarrely, energy is treated as a volatile commodity, right? So it's stripped out of that core metric. Fuel is not, but I would say fuel is fairly volatile. So since we've had that, right, we kind of bottomed out here. And I said, look, the predictions are from OPEC that we will see an increase in Brent crude to the sort of the early 80s. Now, actually, since then, we've overshot that. Okay, so we're actually coming up to $90 a barrel of Brent crude, which is more. So when that starts feeding in, look, could be a slight dip, but it definitely looks like that's broken a pattern and is on their way up. If that starts to spike up, and again, third-party things will affect this, then that's going to feed into supply chain as well. So I'm keeping an eye on those. And then the final scenario is recovery. What do we need to see for recovery to happen? I think, right, for recovery to happen anytime in the next 3, 4, 5 years. I was having a conversation with somebody on this on one of my videos. They said, I think recovery or good times 12 to 18 months or 18 to 24, I can't remember. Personally, I think it's going to be a lot longer than that. And I think if we are going to see a recovery in the next 12 to 18 months in the housing market, that's what we're talking about. It's going to have to be for a significant inflation undershoot, i.e., all of these interest rates, we have gone too quickly and too far, and we haven't given it enough time to bite, and all of a sudden it bites, and we see inflation rapidly undershoot. And if inflation rapidly undershoots and we go deflationary, then we need to look at drop interest rates quickly as well. And of course, we drop interest rates and they go back to that sort of pre-pandemic level, which, by the way, is what the IMF have predicted after inflation is tamed. I think interest rates are likely to return. I mean, again, this is a nice fluffy line. Interest rates likely to return toward pre-pandemic levels when inflation is tamed. So, we're up at 5.5%, 5.75%. If we go down to 3.5%, that is toward it. So it doesn't know where we're going to end up. But if we go back to pre-pandemic levels, of course, asset prices will go back up again. Interesting. So that's where we are. Those are my 3 scenarios. Ooh, wrapped it far too long. Thank you so many people for staying for so long. I'm going to go through some more questions. Give me a thumbs up if that was interesting to break down that nationwide report. Definitely a big movement in terms, just to summarize, definitely a big movement in terms of nominal house price drop this month. I suspect that is the fallout mainly of the swap rates spiking up a few months ago, causing the mortgage rates to spike up a few months ago. And also, what was the other reason for that? That to me is the main thing, right? Oh, sorry, as well as the summer slowdown. I suspect we'll see another decent drop in next month because summer slowdown data will still be feeding into that. Before we probably see a bit of a optimistic or tempering of that as the swap rates come down, mortgage rates come down, and people going, oh, we're bottoming out. Until we maybe, I've always said, I think we'll probably hit trough Q1, Q2 next year, 2024 is my gut feeling, unless it spirals out of control, and then it could continue going through 2024 into 2025. We will see. But I'm not putting any timelines. I'm not putting actual figures on anything. It's just the quantum, and that's where we are. Good. Sean, does the affordability graph take into account interest rates, or is it just nominal value? Interest rates determine affordability as much as the price. It's a very good. So the affordability graph, I assume, Sean, let me just find it, just to make sure we're talking about the same thing. I assume we're talking about this one. So we're talking about affordability or the house price to earnings ratio. This will be based on nominal house prices and nominal earnings. Okay, so not real house prices, not real earnings. It's nominal. So I think in high inflationary environments, right, it's easy to put out these nominal things and paint a better picture than if we're looking at the real. And the thing is, most people don't care about real, because a lot of people go, well, why do I care if my house price is falling in real terms? In nominal terms, it's not. So therefore, the money I put into it, I'm not actually losing anything. If let's just assume it's staying stagnant in nominal terms and dropping in real terms, they don't care because the nominal amount hasn't dropped. They're like, well, I've not lost anything. No, correct. But your nominal amount of money has devalued. So that nominal amount of money buys less. So effectively, you have lost a lot. And it's interesting how people will shout and cry about cash eroding in a high inflationary environment, but completely fail to see that stagnant house prices in a high inflation environment is exactly the same as having cash, right? Because £1 is £1. But if inflation is going up, that £1 will buy you less. It's the same if you've lost 20% in real terms and you sell that. Yes, your debt will have been eroded, but your debt is much more expensive to service because the interest rates have gone up, assuming you're on a variable. So over the course, is it cheaper? Does it matter that it's eroded because you're paying more? That's a piece of analysis I'll be doing soon, based on some scenarios. But you get the equity out, and it's worth less because you can buy less with it, right? So take it to the extreme. House prices stay stagnant, inflation goes up for the next 100 years, and you can sell a house for a price, a loaf of bread. Even though in nominal terms, you haven't lost anything in your house price, but the loaf of bread is now 200 grand. I know that's a ridiculous sort of example, but it is the principle that a lot of people don't seem to care about real, failing to understand that it's their equity is eroding, albeit debt is also eroding. But there we go. Love the nationwide real price graph. The red trend line is a decent proxy for intrinsic value, so consider buying when below and sell above. Yeah, I agree. Let's just go back to that, because I think my gut feeling, right, and if I go back to this graph, I don't think they're changing that trend line. This is not this real thing is not created by Nationwide. It's actually created by this website called housepricecrash.co.uk, which has been there for years, right? They like talking about this sort of stuff. That red line, I feel, if you adjusted it now accurately, would not be going up in that what appears to be a slight parabolic fashion. Although I do agree, it's a very good proxy that if you're below it, if it is accurate, then house prices are cheap, right? If you're above it, then they're not cheap. Now, what I will find, let me just come off this actually, because I've got a better indicator, which I don't delete any of my slides, by the way. So I'm just looking back to see if I can find an interesting slide that you will find. If you're interested in true, is a house price overvalued or undervalued? I just want to find it. And I'm not going to be able to now because I've got too many of these slides. No, here we go. Give me a sec. Here we go. This is the one. Right, you'll like this. So this is the user cost model, right? User cost model that identifies periods of overvaluation. So if you read small print there, proportion by which the house price to earnings ratio exceeds the value implied by a user cost model. So basically, it's not just the house prices, but the cost of owning a house. So you can see we've had a big spike up this year in terms of house prices in terms of this model are overvalued. Now, again, this is on nominal terms, not real terms. So there's so many moving parts and so many, this happens, then that happens in terms of all these different ways of looking at it. But if we look at our house prices overvalued on nominal terms, then they've been way overvalued on nominal terms on this user cost model. And this, again, comes from the Resolution Foundation report. And they seem to believe that this is a much more accurate way of predicting whether house prices are overpriced or underpriced. Because you can imagine it costs so much more to own a house now because of interest rates going up. So something that we don't talk about in residential world very much, but we talk about in commercial world, which is where I sort of work with a lot of my clients to buy property, is actually when you value property on a yield basis, interest rates go up. It's just a very simple equation. Interest rates go up, yields, yield valuations go down, because as an investor, if interest rates are at, 1%, you go and happily buy a property with 5% yield, and you're happy because you're getting more interest rates. If interest rates are at 6%, that property at 5% valuation, 5% yield, you're not going to buy it anymore because you might as well just stick your money in the bank account, right? So if you want to get a margin, let's say you want to get a 4% margin above Bank of England base rate, then if Bank of England base rate is at 6%, you want to buy things at 10% yield. Or if you want a higher margin, then you need to buy them at 11% yield, 12% yield. And a yield-based valuation model means if you need a high yield, the value of that property comes down based on its rent roll, assuming rent roll stays the same. It's just the way. I won't go into the complexities if nobody's sort of worked with commercial valuations. But if you need a high yield, the value comes down because you need to buy it cheaper to get the same yield, if that makes sense, right? So in commercial property, interest rates going up, it's just very linear. All commercial property is much less valuable right now. The bottom fell out of the commercial property market last year, back end of 2022, 40% down. That's where some fantastic opportunity. People say there are no deals out there. Go and buy some super cheap commercial, right? And use permitted development to turn it into residential, get immediate value uplift. There we go. Sorry, I have digressed a little bit. Amy, real house prices take far longer to bottom out than normal, 100%. Anthony, scenario 2 relies on wages continuing to grow, yet the past decade has been the opposite, and with costs elsewhere so high. Oh, sorry, that just flicked away. Costs elsewhere so high, an economic downturn or stagnation is likely. Low growth equals lower wage growth. Yeah, I do also agree with you on that, Anthony. I think we have had this boom in wages in terms of nominal wages, and now it's still booming. And now those real wages, right, have come from negative, which they have been for the last sort of 12 months or so. And they're now sort of getting that crossover point where they are positive in terms of real-time growth as well. So I know for the last 12 months, people have technically been getting poorer. I do think, right, that a lot of people forget that the 12 months before that, post-COVID, there was a massive spike in real-time wage growth. So I just wonder if those balance out a little bit if you look at the last 2 to 3 years rather than the last 12 months. Anyway, we're now tipping into real wage growth being positive. But you're right, how long can this continue for if we are sitting here in basically a stagnant economy with no GDP growth? It's an interesting thing, and it is really down to this supply shock, right? It's down to, I feel, when you start, I hate to use the B word, but when you start to put in Brexit and labour force leaving and so many people out of productive use, this is why when I look at those unemployment figures, it's difficult to assess where we actually are with unemployment, because I reckon unemployment figure now is completely different in terms of what goes into it than, when you're looking at the late 80s, early 90s, for example, or even 2008. Because the way we categorize employed or unemployed, those figures don't include people who are non-productive. So the unemployment is basically people who are available to work, I think, for the last 4 weeks or the next 2 weeks. People who are out of work but available to work in the last 4 weeks or the next 2 weeks are what goes into the unemployment figures. Anybody who's self-employed, regardless if they're working or not, are counted as employed. Anybody on 0 hours contracts, regardless of how many hours they're doing, is counted as employed. So again, my gut feeling is these figures are skewed to such an extent that real unemployment figure or real non-productive or people who are employed but not earning might be way higher than we actually think. And that could tip us, and this is what I mean about the quantum, right? And I'm just talking about probabilities. I would say the least likely thing over the next 2 years is that uptick in value. Uptick in property prices or recovery, least likely by a country mile. Most likely is low and slow, nominal, higher real-time crash. But if those leading indicators continue to go the wrong way, we could actually end up in quite a high nominal price correction as well over the next 12 to 18 months. That's my thoughts. I'm not sticking my mortgage on it. There you go. Matt says they do rebase the trend line each quarter. Is that right? Current trend line is 2.3% above inflation. I mean, if they do, that's fantastic. That is accurate. I just look at it and it looks like it's going parabolically up, which I find slightly strange, bearing in mind it's such a large correction down at the moment. That's the only reason that I question that. I actually don't know, but if that's correct and they do rebase it every quarter, then there we go. That is accurate. Maybe it would be more parabolic. If that wasn't coming down, that could well be it. There we go. I don't know. I'm going to take Matt's word for it. Amazing. Okay, team. Any more for any more? I've been rabbiting on for long enough. I need to go and enjoy my evening. I'll probably do another live end of the week when Halifax put out their figures, which I believe is on Thursday. In the meantime, I always like to get a little plug in. I do have a white paper out there. Link is in the description to this video. It's completely free. It's PDF. If anybody is investing in the property world right now and are struggling, I know that even my own clients look at the markets and go, oh my gosh, should we be in property right now? My answer is yes, right, if you're doing it right. Traditional buy-to-let, no, I would not be getting involved in traditional buy-to-let. Are there some property cash flow multiplier models where we can add value through things like, as I said, buying very cheap commercial property, repurposing it into residential, or various other uses that create a much higher return on our capital? There are some great models out there. If you want to know how I'm doing it, how I think the market's going for investment and landlords in the property market over the next sort of 5 to 10 years, I recommend you download that, have a little read of it, and hopefully you get some value out of it, totally free. Okay, I will see you at the end of the week. Hope you have a great Indian summer, enjoying the weather at the moment, and I'll speak to you probably on Thursday.